Today is February 4th, 2026.
Today's market sent a very clear, yet uncomfortable signal.
The Nasdaq fell intraday as much as -2, 36%, closing at -1, 5%. AI upstream, cloud, and application stocks almost nothing escaped the sell-off.
But here's the interesting part. Value stocks are up, dividend stocks are up, APL and MSFT held up.
This isn't panic. This is the second phase of risk-off.
Many ask, if this is a bubble, why didn't 2-year, 10-year, yield spreads, unemployment, or lay flash warnings?
One sentence sums it up. This isn't an economic bubble, it's a capital allocation bubble. Employment supported by fiscal policies and interest rates distorted by QRRP, and money funds productivity boosted temporarily by AI. Traditional macro indicators react slowly to imbalances inside financial markets.
What is really going on in the market today? Let's break it down. We saw some big names get hit hard. Think about the semiconductor giants like Nvidia, ASML and AMD. Even popular growth stocks like Palantir, Meta and Tesla took a serious dive. So who survived or even gained ground? Well, Apple and Microsoft held up surprisingly well. And if you look closely, value stocks and those reliable dividend payers also managed to stay afloat. So what's the big takeaway here? It seems the market has stopped paying for long-term stories and future promises. Right now, it's all about one thing: certain cash flows. This isn't just an emotional sell-off. It's a classic case of valuation getting too high combined with duration pressure from rising rates. Investors want to see the money now, not just dream about it later.
I have to be honest, looking at the monitors today feels a bit like watching a slow-motion car crash, where the drivers are actually driving really well.
Yeah, that's one way to put it.
It is February 4th, 2026. And if you've logged into your brokerage account this morning, you're just seeing a sea of red. The S&P 500 is dipping under 6,900, the Nasdaq's down 1.3%, and the vibe is just heavy.
It is.
But here's the thing that's driving me up the wall. The companies leading this sell-off aren't failing. In fact, some of them are posting record numbers. So we have to ask the question, is this just a temper tantrum by the market, or are we looking at the start of a genuine regime change?
It's definitely more than a tantrum. You know, I don't like to use the word crash lightly, and I don't think we're there yet, but the price action today is significant.
Okay.
We are seeing a very specific psychological shift. The analysts I've been reading this morning are coalescing around a theory called the 3-stage exit strategy. And unfortunately for our portfolios, they think we just graduated from stage 1 and landed squarely in stage 2.
The 3-stage exit. Sounds like something a corporate HR department invents to fire you politely.
Well, it's actually a behavioral finance model for how bubbles deflate. The theory goes that stage 1 is the valuation warning.
Okay.
Think back to mid-2025. The dashboard lights were flashing, red PE ratios were climbing into the stratosphere, insiders were selling record amounts of stock, but the price action just ignored it.
Because the narrative was too strong, we were all drunk on the AI Kool-Aid. Every dip was bought because AI changes everything.
Precisely. That was the denial phase.
Yeah.
But stage 2, that's what we're seeing today. They call it mainline bleeding or valuation-driven de-risking.
Right.
It's when the market wakes up with a hangover, looks at the bill, and realizes the party wasn't worth the cost. It's no longer about whether the tech is real, it's about whether the price is insane.
And that brings us to the mission of this deep dive. We need to figure out why good earnings are suddenly toxic. We need to talk about Kevin Warsh, because his name is all over the bond market today, and we need to decide if we're looking at a quick correction or a lost decade.
The stakes are high. And I think the best place to start is with that good news is bad news paradox you mentioned, because looking at Microsoft today, the reaction is baffling if you're using a 2024 playbook.
Baffling is an understatement. I was reading the Microsoft earnings report earlier. EPS came in at $4.14. The street was expecting $3.91. That is a solid beat.
A huge beat.
In any normal market, the stock pops 5% and we all high-five. Today, it's down 1.6%. It feels like the goalposts aren't just moving, they're being strapped to a rocket and launched into orbit.
The goalposts haven't moved, the stadium is just completely full. We call this expectation saturation.
Expectation saturation.
Imagine a sponge that is sitting under a waterfall. It is 100% saturated. You can pour more water on it, even a record amount of water, but it cannot hold another drop.
So the market had already priced in perfection.
Perfection was the baseline. When a company is trading at the multiples we're seeing, investors aren't paying for great quarters. They have effectively paid upfront for the next 10 years of miraculous growth. So when Microsoft comes out and says, hey, we did really well, the market shrugs and says, you were supposed to.
That's a tough row. But it's not just Microsoft. Look at the AI darlings. NVIDIA is down almost 3% today. Meta is down 1.4%. This feels like more than just an earnings miss. It feels like the AI premium is being stripped out.
You're hitting on the core anxiety of stage 2. It's the ROI audit.
ROI audit.
For the last 3 years, capital expenditure CapEx was the hero. If a company said, we're spending $10 billion on AI chips, the stock went up. Now the script has flipped. Investors are looking at that $100 billion infrastructure build-out. They're looking at the reports that OpenAI's next model is stalling slightly, and they are asking, where is the cash?
Right. They want to see the receipts. It's not enough to buy the GPUs anymore. You have to prove they are printing money today, not in 2030.
And that puts NVIDIA in a tough spot. They are the ultimate shovel seller. If the software companies, the miners, start getting audited by their shareholders and have to cut back on buying shovels,
NVIDIA's growth trajectory comes back down to earth.
Exactly. That's why you're seeing that specifically sharp 2.89% drop today. It's a repricing of the entire ecosystem.
However, and this is why I'm not totally spiraling into panic mode yet, it's not a universal slaughter. I'm looking at my watch list, and Apple is actually green, like very green, up over 4%.
Yep.
Caterpillar's up 5%. Micron up 5.5%.
Yeah.
If this was a crash, wouldn't everything be flushing down the toilet together?
That is the single most important data point on your screen. This isn't a panic, it's a rotation.
A rotation.
Capital isn't leaving the stock market, it's fleeing uncertainty and hiding uncertainty.
It's funny to think of Apple as a hiding spot, given it's a tech giant, but I guess compared to the AI speculative trade, it's a bond with a logo.
That's a great way to put it. Apple has net profit margins of 29%. They have an ecosystem that people are locked into. In a world where investors are suddenly scared of vaporware or distant promises, Apple is a fortress.
It's real.
They sell a real physical product to loyal customers today.
And Caterpillar, that feels like a throwback.
It's the same logic. Caterpillar represents industrial reality. If you believe the AI hype is overblown, where do you put your money? You put it in the companies that build the roads, the bridges, the data centers.
So you move from growth at any price
to reasonable price for cash flow.
So we're seeing a rational swap. Sell the dream, buy the reality. But we have to talk about the catalyst for this, because it's not just earnings. It's the macro picture, the Warsh effect.
This is the elephant in the room. President Trump nominating Kevin Warsh as the next Fed chair has sent a shockwave through the bond market that I don't think retail investors fully appreciate yet.
I know Trump wants lower rates. He's been shouting about it for years. And Warsh is supposed to be the guy to deliver that. So logically, if rates are going lower, shouldn't stocks be flying high? Why is the bond market freaking out?
Because Kevin Warsh is a complex figure. Yes, he might be open to cutting the short-term Fed funds rate, but, and this is a huge but, he is a balance sheet hawk. He hates the fact that the Federal Reserve is sitting on $7.7 trillion of assets. He views it as a distortion of free markets.
So the fear is that he's going to drain the swamp, or I guess drain the liquidity pool.
Exactly. The Warsh-Trump paradigm is a trade-off. The market thinks we'll get lower short-term rates, but Warsh is going to aggressively sell off the Fed's bonds to shrink that balance sheet.
And when the Fed sells bonds, or just stops buying them,
who has to buy them? The private market. And to entice the private market to buy all that debt, yields have to go up.
Supply and demand. If you flood the market with treasury bonds, the price goes down and the yield goes up.
Correct. And that is why the 10-year treasury yield is pushing toward 4.5% today. The risk-free rate is rising because the market anticipates a flood of supply from a Warsh-led Fed.
Okay, let's connect the dots for the listener. Why does a 4.5% yield on a boring treasury bond hurt a sexy AI stock like NVIDIA?
It's gravity, pure and simple. The value of a high-growth tech stock is almost entirely based on profits they are expected to make 10 or 15 years from now.
Right, way in the future.
When you value those future profits, you have to discount them back to today's dollars. The number you use to do that math, it's the 10-year treasury yield.
So when the yield goes up, the math equation automatically spits out a lower value for the stock.
It increases the hurdle rate. If I can get 4.5% guaranteed from the government, your risky AI stock better offer me a hell of a lot more upside to be worth the headache.
Right.
As that safe rate rises, the premium on tech evaporates. That's the mechanism crushing the Magnificent Seven today.
Feels like we're rhyming with history here. I was reading the notes about the Nifty 50 era in the 1970s. For those who don't know, these are the one-decision stocks.
Yeah.
Xerox, Polaroid, IBM. You bought them, you never sold them. They were the Magnificent Seven of their day.
The parallels are actually haunting. In 1973, those companies were amazing businesses. They dominated the world.
Sure.
But their valuations got so detached from reality that when the monetary regime changed, when inflation and rates shifted, the stocks didn't necessarily go to zero. They just did nothing.
Dead money.
For a decade, you held IBM and it went sideways while inflation ate your lunch. That is the stage 2 risk. It's not that Microsoft goes bankrupt. It's that Microsoft spends the next 7 years trading between $400 and $450 while the rest of the economy moves on.
And that brings us to the scary number. The valuation metric that keeps bears up at night. The Shiller PE ratio.
The KP ratio, it's cyclically adjusted, so it smooths out the noise. Right now, it's sitting at 40.32.
For context, the historical average is what, 17, 18?
Usually between 15 and 20, we are double the historical norm. And here's the kicker. The only other time in history it has been above 40 was the peak of the dot-com bubble in 1999.
But wait, I had to play devil's advocate here. In 1999, companies were adding .com to their name and had zero revenue. They were selling pet food online and losing money on every bag.
Sure, I get it.
Today, the S&P 500 earnings growth is 11.9%. These companies are cash-printing machines. Doesn't that justify a higher multiple?
And it justifies a higher multiple, sure. Maybe 25, maybe even 30. But 40, that assumes nothing ever goes wrong again. The bull argument is that earnings are real, and that's true. This isn't a vaporware bubble. It's a price bubble. We are buying a Ferrari, but we are paying the price of a spaceship. That car is great, but we still overpaid.
And the danger of overpaying is amplified when you're doing it with borrowed money. I saw the margin debt numbers, $1.226 trillion.
Yeah.
That is a lot of leverage in the system.
That's the powder keg. When you buy stocks on margin, you are borrowing against the value of your portfolio. If the market dips, say a 10% correction, your broker calls you up and says, put in more cash or we sell your stocks.
The dreaded margin call.
And that turns a rational sell-off into a forced liquidation. Look at MicroStrategy today, down almost 7%.
Wow.
That is a highly leveraged proxy for Bitcoin and tech. When that starts falling, it triggers algorithms which trigger margin calls, which forces selling of other assets to cover the hole. It's the contagion risk.
Okay, you've sufficiently terrified me. We have sky-high valuations, a Fed chair who wants to drain liquidity, and $1 trillion of margin debt sitting on a hair trigger. Why aren't we in a full-blown crash right now? Why is Apple up? Why isn't the VIX at 50?
Because the floor is solid. This is the crucial nuance. We are in stage 2 bleeding, not stage 3 systemic crisis.
Yeah.
And the reason we aren't crashing is that the actual economy is doing fine.
The soft landing is actually happening.
Look at the IMF data released in January. Global growth is steady at 3.3%. They actually upgraded the U.S. growth forecast to 2.4%. We aren't in a recession. People have jobs. Wages are okay. This isn't 2008 where the housing market is collapsing.
Right.
This is a valuation adjustment, not an economic collapse.
Plus, the trade war fears seem to have cooled off a bit, right?
Significantly. The tariff truce with China runs until November 2026. That removes a massive geopolitical landmine from the chart. But the biggest reason the market isn't crashing, it's the cash wall.
I love this concept. Tell me about the $7.7 trillion.
There is $7.7 trillion sitting in money market funds right now. That is a record amount of cash sitting on the sidelines earning 4 or 5% interest.
That's dry powder.
It's the ultimate safety net. If stocks drop 10% or 15%, suddenly that cash looks at Microsoft and says, hey, at this price, that looks like a deal. That money steps in and buys the dip. It acts as a natural buffer that prevents the bottom from falling out completely.
So as long as that cash is sitting there, we probably won't see a straight line down. It'll be choppy.
Exactly. A grind, not a crash. Unless.
Unless. There's always an unless. What breaks the cash wall? What are the signals for stage 3?
The 3-stage exit theory has 3 specific red flags. If you see these, it means the safety net has failed. First, the VIX. It's around 20 right now, which is elevated but manageable. If it breaks 30 and stays there, that is panic.
That's the panic button.
That means the cash wall is too scared to step in. Second, credit spreads. This is the plumbing of the financial system. Right now, companies can borrow easily. If spreads blow out, meaning lenders suddenly demand huge premiums to lend to corporations, that means the credit gears are seizing up.
And that turns a stock market problem into a real business problem.
You got it. And the third,
What is it?
the generals falling together. This is the one to watch closely. If you see a day where Microsoft, Apple, and Nvidia all break their long-term trend line simultaneously, down 4%, 5% each, and you don't see money rotating into Caterpillar or healthcare, if everything is selling off at once.
That means someone is rushing for the exit and selling whatever isn't nailed down.
Exactly. That is the sign of a liquidity event. That is stage 3.
So to wrap this up for the listener who is trying to keep their head straight, we are in stage 2. It's an audit. The market is checking the receipts on AI and realizing the price tag was a bit high. We're seeing a rotation into cash flow uncertainty like Apple, driven by high valuations and the new Warsh regime of tighter liquidity.
That is the summary. It's a painful, but I think rational repricing. We are moving from narrative pricing, where the story was all that mattered, to cash flow pricing, where the math has to work.
So no panic selling, but maybe check your leverage and make sure you own companies that actually make money today, not just in a slide deck for 2030.
And keep your eye on liquidity, because I'll leave you with this thought. The market is currently pricing in a scenario where AI doubles our productivity and saves the economy. But we have Kevin Warsh about to step in and pull the plug on the liquidity bathtub to fix the Fed's balance sheet.
I have a feeling I know where this metaphor is going.
The question is, can these giant AI companies still swim when the water level drops? Or, as the liquidity drains out, are we finally going to find out who has been swimming naked?
A terrifying image to end on, but a necessary one. Keep watching those yields and don't take your eyes off the VIX. Thanks for diving in with us today.
Stay sharp, everyone.
AI-assisted analysis and illustrative visuals. Educational content only, not investment advice.